Hey friends, welcome back to Wealth for You. Let me ask you this. Should you focus on capital gains or dividends? And more importantly, does that answer change as you get older? If you're aged 25 to 55 and living in Singapore, this video could be a game changer for your investing journey. Because here's the truth, most people get this wrong. But if you get it right, you'll be one step closer to becoming cash flow rich, not just asset rich. So stay till the end, because I'll show you how to make the most of both, even if you're just getting started. And hey, if you find this video helpful, do me a quick favor. Give it a like, subscribe to Wealth for You, and help this message reach more everyday investors just like you. Now let's break it all down, simply, clearly, and with zero jargon. Disclaimer. This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Part 1. Understanding the basics. Imagine this. You're walking past your favorite bubble tea shop, BBT Holdings. You've been there so often you start thinking, what if I owned a piece of this? So one day, you decide to invest in the company. But here's the thing, you're not just buying a stock ticker. You're becoming a part owner of that business. As a shareholder, you now benefit when the business makes money. And there are two main ways that happens. 1. Capital gains, when the share price goes up. 2. Dividends, when the company pays out cash from its profits to you. Let's explore both. And we'll stick with our bubble tea business to make this super relatable. Part 2. Capital gains. Growth mode. Now let's say the founder of BBT has big dreams. He takes the profits from his 10 outlets and reinvests them, opening 5 more stores across Singapore. The business is growing. Revenue goes up, profits increase, and the market starts to notice. More investors want a piece of the pie, and the share price rises. That's your capital gains. Your investment becomes worth more because the company is expanding and growing in value. This strategy is ideal if you're in your 20s or 30s. You've got time on your side to ride the ups and downs and wait for the business to grow. Part 3. Dividends. Income mode. But let's flip the story. What if the BBT founder says, you know what? We're done expanding. We're doing well. Let's just reward our loyal shareholders. So instead of opening more stores, the company starts distributing its profits as dividends. Every year, you get a portion of the earnings, maybe $5,000 or $10,000 in cash, straight to your bank account. You don't have to sell your shares to benefit. You just sit back and collect. This is especially helpful if you're in your 40s or 50s and you want more stability and passive income to fund your lifestyle, support your kids, or even take that well-deserved holiday. Part 4. Which strategy fits your age? So let's bring it all together. Which one should you focus on? Capital gains or dividends? Well, that depends on where you are in life. Number 1. In your 20s to 30s, plant the seeds of growth. Picture yourself just starting out. You're in your 20s or early 30s. You've landed your first job, started saving a little, and thinking seriously about building wealth. This is your planting season. It's the best time to go for capital gains. Why? Because you've got time on your side. Time to ride out the market ups and downs, take a bit more risk, and let your investments compound. Think tech companies, innovative startups, or even growth-focused REITs. You're not depending on your investments for income yet. You're letting your money snowball quietly while you focus on your career, learning, and living. But here's a smart move most young investors miss. Even in your 20s, consider setting aside a small part of your portfolio, maybe just 10 to 20%, for dividend-paying stocks or stable REITs. Why? Because dividends teach you the habit of earning passive income. Even if it's just $10 or $50 a month, it's real money coming in, not from your job, but from your investments. It's a mindset shift, and the earlier you start, the better prepared you'll be for the future. So even in your 20s or 30s, you can start building a small dividend portfolio. especially with REITs like Mapletree Industrial Trust or Capitaland Integrated Commercial Trust. You'll get 4 to 6% yield and learn how to create passive income early. So yes, plant for growth, but also plant for cash flow, even if it's just a few seeds at the start. Number 2. In your 40s to early 50s, start shifting gears. Now, fast forward. You're in your 40s or early 50s. You've probably got more responsibilities, maybe a mortgage, kids, or aging parents. At this stage, it's wise to start shifting gears. Keep some growth investments, yes, but begin adding dividend-paying stocks into the mix. You want a portfolio that not only grows but also starts giving back, with reliable cash flow that can support your lifestyle or take the edge off rising expenses. This is the balance phase, growth plus income. Number 3. In your late 50s and beyond, time to harvest. Now, you're in your late 50s or heading into retirement. This is your harvest season. You've spent decades building your portfolio. Now it's time for that portfolio to start paying you back. Focus more on dividend income. Think stable REITs, banks like DBS or UOB, or mature businesses that pay consistent dividends. These are your cash cows, giving you monthly or quarterly payouts to fund your lifestyle without needing to sell a single share. It's about peace of mind, predictability, and freedom. Closing thoughts. Let's be honest. The best investment portfolios aren't about choosing sides. They're about balance, tailored to your age, your goals, and how you want to live. Capital gains give you the fuel to grow, to build wealth faster when you're young and hungry. Dividends give you the peace to rest, especially when you want consistency, stability, and income. If you're in your 20s or 30s, yes, chase growth, but don't ignore dividends. Start small, learn early, and if you're in your 40s or 50s, yes, lean into dividends, but don't be afraid to let part of your portfolio continue growing. Own great businesses, grow your wealth, collect your cash flow. And remember, as we always say here at Wealth for You, don't just be rich, be cash flow rich. So what's your focus right now? Capital gains or dividends? Or maybe a bit of both? Drop your thoughts in the comments. I'd love to hear from you. If you found this video helpful, give it a thumbs up, subscribe to Wealth for You, and share it with a friend who's just starting their investment journey. We've got new videos every week to help you build real, lasting wealth, not just for today, but for your future self. Thanks for watching, and I'll see you in the next one.